Hi guys, in today's video I'll be talking about our relative value metric and the correlation not just with Bitcoin but with gold and the S&P 500. So that should give us, I guess, a pretty good look at a comparison of something which is a store of value, which is gold, against something which we think is a store of value, which is Bitcoin. So let's get started revisiting our Bitcoin correlation and comparing that against our relative value metric. So a quick recap for those who haven't watched my videos is that this value metric, which is inverted here, is the DXY over WM2NS. And that is to say, what is the relative value of the US dollar against a basket of currencies for what the money supply is, or how much money printing has been happening. I suppose the next question is, how can both of these be going up? If the value in the US dollar is going down, then we would expect that it'll take more dollars to purchase the same asset. So what I've actually done here is inverted this fraction so that as the US dollar is decreasing in value, we're actually seeing our relative value metric trend up so that we can see that correlation with our asset. So pretty good correlation with Bitcoin. Let's take a look at gold. Alright, so what I've done, maybe not always the best correlation, but if you move things locally, then correlation is pretty decent. And that's because this relative value metric is relative. It doesn't capture all transformations in value. For instance, if all of the countries in the basket of currencies in the DXY were all stable against each other, but they were having sensational GDP and the value of all of their currencies was increasing at the same amount, then the DXY would be completely stable and our chart would go sideways, but we would see the value of our assets decreasing because this value metric doesn't capture everything, but I think it's good enough because we get pretty solid correlation. So what's happening with gold? I have shifted this chart, scaled gold and Bitcoin each so that they fit nicely and correlate against our value metric, and I've shifted gold so that we get pretty nice correlation recently. So we can see back in 2008, little crash in gold, which correlates with, corresponds with the 2008 financial crisis, what appears to be some overvaluation for gold followed by a correction, and then looks like a long period of consolidation before we start trending up again. So I'll adjust this chart so that we correlate nicely around here. Then I suppose we consider that we've entered some undervaluation, and then when the money printers have gone crazy, we've seen actually quite a quick response in gold where all of that money is poured in, inflating that asset, or the value of the dollar is decreased, so that asset increases in the number of dollars you need to purchase it. Then, much like with Bitcoin, we've seen it break that correlation where it's just not trending quite the same, and that's fine. We've seen in other places for both Bitcoin and gold that it doesn't correlate perfectly well all the time. So now that we've compared both gold and Bitcoin, I think both seem pretty solid as a store of value if you consider this metric of relative value for the amount of money printed to be your measure of value. So now let's have a look at the S&P 500. Alright, so we'll turn off Bitcoin and gold, and we can see same sort of thing, 2008, crash, perhaps a period of undervaluation, though if we move our charts around locally we get good correlation, so there's obviously some external factor which we can't account well for here, but overall pretty decent. So now if we shift to have nice correlation from about 2015, what do we see? We see that the S&P 500 has actually continued correlating fairly well with our value metric from when the money printers switched on in early 2020. So I guess what does this mean? Is the S&P 500 a better store of value than gold or Bitcoin? I'd say, looking at the history, at least against this metric, I'd say no. There's periods of gross overvaluation. That, of course, would be the dot-com bubble, and then periods of undervaluation. So I guess what does all of this really mean for us? In my previous videos, I had spoken about how I had this theory that whilst all of this money is sloshing about from all of this stimulus, that it's not actually going to your regular citizen, it's going into corporations and financial institutions. And it's less likely that they're willing to make allocations into assets like Bitcoin. It's just not a traditional asset. Maybe it's difficult for them to make those allocations, so it's taking a while for that money to find its way into Bitcoin. And for some reason, we might be seeing that for gold too. What we are seeing though is that the S&P 500 is continuing to run, leaving, I'd say, gold and Bitcoin here, at least against this value metric, kind of leaving them in the dust. So I would think that this almost fits with that theory in that those financial institutions, companies, businesses that are getting these stimulus, they're pretty much punting it on the S&P 500 and speculating that that's where they'll make some money. So what could we see? I'm making this video around the time of the Evergrande news coming out that they're going under, and we've seen a pretty nice little correction on the S&P 500. My thoughts are that the S&P 500 is probably in a large speculative bubble, and when that pops, I think that could be a trigger for where we see things which are a store of value. Of course, they'll go down first when something pops. Everything goes down, but that might be after that point we might see gold and Bitcoin have a bit of a recovery against our correlation with this value metric, as investors, I guess, become risk averse, not willing to speculate on the stock market anymore. They want the safety of true stores of value. Well, when I say true as we've got like gold and Bitcoin. Alright guys, that's all I wanted to chat about today. I'll see you in the next video.